How's it going, everyone? My name is Dan, but you can call me Malone, and this week I sold all of my ETF investments. In this video, I'm going to explain why exactly I decided to sell, and more importantly, where I reinvested the proceeds. The first investment I ever made in the stock market was an ETF. However, back then there wasn't a lot of information available to Irish investors when it came to developing a strategy for investing in ETFs. When I reflect on my ETF investments, it's clear that I hadn't thought out my strategy in full, and up until now my portfolio hasn't been as efficient as it could have been. So I'm sharing my learning experiences with you today in the hope that they might help you out when you're trying to decide what ETFs to invest in and why. Before we get started, could I ask that you take 2 seconds out of your day to leave a like, and if you are new around here, don't forget to subscribe. So without further ado, let's get started. 2 weeks ago, I uploaded a video where I discussed how ETFs are taxed in Ireland. Highly recommend that you check out that video. In that video, we mentioned how there are two types of ETFs, accumulating ETFs and distributing ETFs. The main difference between the two is that with an accumulating ETF, any dividends which are owed to you as an investor are automatically reinvested into the fund for your benefit. The advantage of this is that the dividend isn't taxed within the fund, so the gross value of the dividend is reinvested. Distributing ETFs, on the other hand, will pay out any dividends owed to you into your brokerage account. This means you'll be able to reinvest the dividends elsewhere if you so choose. However, the downside here is that you will have to pay tax on the dividend. So up until now, I had been investing into a distributing ETF, more specifically the Vanguard S&P 500 UCITS ETF, ticker symbol VUSA. The reason why I was investing into a distributing ETF was because I wanted to have the option to reinvest my dividends into other investments if I wanted to. But this didn't really make sense as an investing strategy. By choosing to receive the dividends into my brokerage account instead of having them automatically reinvested, I was optionally choosing to pay tax on the dividends. Investing in accumulating ETFs is one of the most tax efficient investing strategies that you can utilize as an Irish investor. This strategy also amplifies the effects of compound interest over time because the gross before tax investment income of the fund is being reinvested to earn you even more income. Compare this to investing a net dividend received after tax, or even reducing the amount of cash available in your bank account for investment by having to pay tax. So because I'm planning on holding my ETF investments for decades, it just didn't make a whole lot of sense to not invest in accumulating ETFs. So when I sold all of my VUSA shares, I decided to reinvest the proceeds into 3 separate accumulating ETFs. Each of these ETFs are domiciled in Ireland and regulated under UCITS. Again, I highly recommend you check out my ETF tax video to find out why that's important. The first ETF I bought was the iShares S&P 500 EUR Hedged Accumulating ETF. The main reason why I decided to buy this particular S&P 500 ETF is because it's a Euro hedged share class. When you invest in an S&P 500 ETF as an Irish investor, you're exposed to currency risk. The reason why this is true is because you as an Irish investor use the euro, but the stocks that the fund holds are denoted in US dollar. So if the value of the investments held by the fund increased by 10% in 1 year, but in the same year the value of the dollar fell 10% relative to the euro, then your true investment return is actually nil. And the reason for this is because your investment returns have been wiped out by changes in currency value. So a euro hedged share class effectively eliminates this risk by using derivative contracts known as forwards. The main reason why I'm investing in the S&P 500 in the first place is because I believe in the leading US companies and I want to have an interest in their success. I'm not investing in these companies to gain an exposure to the returns of the US dollar. So by investing in a euro hedged share class, this allows me to execute that strategy. Now this strategy does come at an extra cost, with the total expense ratio of the fund sitting at 0.20%, as compared to my Vanguard ETF, which had a total expense ratio of 0.07%. However, I do believe that in the long run, the protection that this fund offers me against a falling dollar outweighs the higher costs associated with the fund. The next ETF I bought was the iShares Msci Emerging Markets Accumulating ETF. One of the main issues with my previous ETF strategy was that it was entirely focused on the United States. While the S&P 500 has performed well over the course of the last year, in the long term I think I would be better served having more global diversification in my portfolio. There's been lots of talk around the growth potential of emerging markets going forward, with the likes of S&P Global raising their outlook for emerging markets earlier this year. And emerging markets have some of the highest levels of GDP growth worldwide. While emerging markets certainly do have high growth potential, they aren't without their fair share of challenges either. But I am willing to take on that heightened level of risk for a potentially higher investment return in the future. The total expense ratio of this fund is 0.18%, and it will provide you with exposure to companies like Taiwan Semiconductor Manufacturing, Tencent and Alibaba. The last ETF I bought was the iShares Msci Europe Accumulating ETF. Again, the goal here was to gain exposure to higher levels of global diversification outside of the United States. This ETF actually includes UK companies as well as European companies despite Brexit. It was actually clarified in an MSCI Q&A that all countries within the Developed Markets Europe Index, including the UK, will continue to be treated as a single market for the purposes of the index. This is important because UK companies currently account for over 20% of the fund, so if they were to be removed, this would obviously drastically reduce diversification and likely growth potential. This ETF has the lowest total expense ratio of all my new ETFs, sitting at 0.12%. Now you might be wondering why I didn't just invest in a global stock market ETF instead of investing in 3 separate ETFs from different regions. The main reason why I chose to avoid global ETFs was simply because I wanted to have the ability to concentrate or divest my cash in certain regions over time. If I wanted to intensify my investments in emerging markets specifically tomorrow, I wouldn't be able to achieve that by investing in a global stock market ETF. I also find that global ETFs are heavily weighted towards the US anyway and usually run higher total expense ratios. So those are the changes that I've made to my ETF investing strategy. I feel by implementing this new strategy, I've increased the overall level of diversification in my portfolio. I've simplified my tax position by investing in accumulating funds, and I'm also maximizing my ability to earn compounded and tax efficient investment returns. The main thing that I've taken away from this experience is that your investing strategies are going to change over time as you become a better investor. It's perfectly fine to make mistakes or slips in judgment when it comes to your investments. In fact, it's probably encouraged that you make those mistakes so that you can learn from the experience. Never stop learning and always strive towards becoming the best version of yourself that you can be. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.